So for today, we're gonna go ahead and analyze the McDonald's stock. If you look at this chart for MCD, which of course stands for McDonald's, they've been able to grow revenue year over year. Some years there was a slight dip, but they hit a high in 2013, and then ever since 2013, they have been seeing a decline. And McDonald's has been able to increase its net income year over year. Some years it was a slight dip, but on average, if you look at the trend, it's been an upwards trend when it comes to the net income. Now, this is actually pretty interesting because as you can tell, even though the revenue has been in a decline, the net income has actually been in an upward trend. Now, this tells me that management is doing a great job at increasing their profit margin. What I'm looking for when I look at the profit margin is stability and consistency. And as you can tell that McDonald's has been able to grow its profit margin all the way up into the above the 20% in the last few years. McDonald's is buying back its shares, and currently there are 765 million shares outstanding. So every single year pretty much they have been buying back shares. I like to see the debt to equity ratio be below 1, and I'm also looking for consistency. And as you can tell by looking at McDonald's, they have been able to keep their debt to equity ratio below 1. Now, the debt to equity ratio pretty much tells you how much debt a company has compared to the shareholders' equity. One thing that I also like to look at, besides the debt to equity ratio, is how fast a company can pay down its total liability, which is its total debt, based on the net income it produces. So for McDonald's, I looked at the last few years. It's a simple calculation. You take the total liabilities divided by the net income before taxes. And I like to see this be below 7 or even 5. And for McDonald's, it hovers around 4.5 and 5 years, which is great. With return on equity, I like to see this in the double digits. So anything above 10%. And McDonald's has been able to keep it above 15%, actually going up to 20%. And I'm also looking for consistency, of course. So this is looking really great. The return on equity pretty much tells you how much net income a company is able to produce based on the shareholders' equity. The higher, the better. What you'll usually see is that companies that have a moat or companies that have a competitive advantage usually have a high return on equity. The next one that I look at also is the return on invested capital, which I also want to see in the double digits. And above 10%, okay, dip down to 5%, but on average, McDonald's has been able to keep it above 10% and even all the way up to close to 20%, which is awesome. Now, before I purchase a stock, I always pay attention to the PE ratio. And looking at McDonald's, currently they have a very high PE ratio of 35. I like to see my PE ratio be below 20, and below 15 is even better. So McDonald's, I own stock in this company. I am not gonna purchase any additional stocks at a PE ratio of 35, but I do have McDonald's on my watch list, and if this PE ratio comes down to 20, I will jump back in and do some quick analysis, see what the numbers look like, and if everything looks good, I'll go ahead and purchase some additional shares in McDonald's.